You've seen it everywhere. On shelves, at gas stations, in the hands of gamers, skaters, gym bros, and college students pulling out all-nighters. It's the Monster Energy. It is loud, aggressive, neon green chaos in a can. But what if this edgy energy drink, the one that you may have grabbed once before a workout, has quietly become one of the greatest stock market success stories in the history? Yeah, not Apple, not Amazon, but Monster Energy. Over the last 24 years, Monster Beverage has delivered over 100,000% returns to investors. That's a 34% compounded annual growth rate for 2 straight decades. And it did invent a smartphone, it didn't revolutionize cloud computing, it just sold caffeinated drinks with wild names like Pipeline Punch, Ultra Paradise, and Assault. So how the hell did this happen? In this video, we are diving into the insane and the true story of how Monster went from near bankruptcy by selling fruit juices to outperforming almost every major tech company in America. You'll see how smart branding, wild marketing, and one genius pivot turned a basic beverage company into a stock market monster. Now we'll break this down into 3 different stages. Stage number 1 is from fruit juice to firepower. It's the late 1990s. Energy drinks weren't really a thing yet, but Red Bull had just started, flown in from Austria, and was still a niche brand. The idea of paying $2 for any tiny can of sugar and caffeine, kind of ridiculous. And then there is Hansen's Natural Soda, a struggling California company known for selling natural fruit juices at health food stores. Think of like apple juice, kiwi strawberry blends, a touch of granola vibes, the kind of drinks your mom might buy, but at Whole Foods before it was cool. By 2001, Hansen wasn't doing well. Sales were flat, margins were very tight. The company was, in Wall Street terms, an afterthought. In fact, the stock was trading under 0.10 per share. Yes, 10 cents. The whole business was valued at under $20 million. You could have bought the entire company for less than the cost of a Manhattan apartment. And yet, in the middle of this slow bleed, Hansen made a bet. A big, weird, risky bet. They decided to create an energy drink, but not just any energy drink. This one wouldn't appeal to soccer moms or health food stores. This would be a drink for the underground. Hansen wasn't trying to compete with Red Bull sleek European cool. They were going to be the anti-Red Bull, the punk rock energy drink. And so in 2002, they launched a new brand called Monster Energy. Black can, neon grand claw marks, twice the size of Red Bull, loaded with caffeine, and priced cheaper than Red Bull. And here's where the whole story gets interesting. Within just a few quarters, Monster started catching fire quietly. Not in Wall Street headlines, but in gas stations, skate parks, convenience stores, near college campuses, anywhere Red Bull wasn't cool anymore. By 2004, Monster had become Hansen's best-selling product, and by 2005, it was driving nearly all their growth. The juice company basically dead. The energy drink exploding. So in 2012, they made it official. Hansen's Natural was no more. The company renamed itself Monster Beverage Corporation. And that 10-cent stock, by 2012, it had already hit $13. That's a 13,000% gain in a decade. But the real run was just getting started. Now coming to stage 2, marketing like a monster. So how do you go from being a no-name challenger brand to taking on giants like Red Bull and Coca-Cola without spending the Coca-Cola money? Simple. You flip the whole marketing playbook upside down. No Super Bowl commercials, no glossy magazine ads, no celebrities slipping Monster on a yacht. Monster wasn't about looking expensive. It was about looking real. Monster's strategy was basically to go underground. They didn't want to appeal to everyone. They wanted to appeal to the right people. The rebels, the adrenaline junkies, the night gamers, the people doing backflips on dirt bikes in the desert at 3 a.m. They made a strategic decision early on. We don't market, we sponsor. Monster flooded the scene with grassroots sponsorships, not billion-dollar deals, but hundreds of $10,000 to $100,000 of partnerships with MMA fighters, motocross teams, skaters, snowboarders, BMX riders, esports teams, and gaming creators. And this wasn't a logo on a banner kind of a sponsorship. They immersed themselves in these communities. They gave out free drinks at underground events, built relationships with athletes long before they were famous, ran pop-up stage events at festivals, became a part of the scene. Monster wasn't trying to get everyone to like them. They were just trying to get to a specific 10% to love them. And it worked. By 2010, Monster had created a tribe. The black and green claw wasn't just a brand, it was a badge. Skateboarders wore Monster hats, college gamers kept fridges full of it, motocross riders tattooed the claw on their arms. This marketing model was low budget but high impact, was brilliantly efficient, and in 2011, Monster spent just 3.4% of their revenue on advertising, whereas Red Bull was spending more than 30%. Yet in the US, Monster was gaining share faster. The impact was basically of the brand loyalty to the pricing power. Because of that deep emotional connection with its base, Monster could quietly raise prices without the usual customer churn. Between 2006 and 2016, Monster increased its gross margins from 52% to over 60% while doubling sales every few years. By the late 2010, Monster was the second number energy drinks globally, only behind Red Bull, and in many US markets, it had surpassed Red Bull in unit volume. And Monster was basically now growing faster than Red Bull without spending even half as much. Now, coming to stage 3, Coca-Cola effect and the numbers behind the roar. By 2014, Monster was already a growing beast. Its edgy branding, loyal following, and strategic retail positioning had earned it a powerful spot in the US energy drink market. But there was a ceiling, a global one. Monster was great at marketing, but what it lacked was reach. Trucks, fridges, shelves, and distribution muscle across continents. And then came Coca-Cola. In August 2014, Coca-Cola announced it would invest roughly $2.15 billion in Monster Beverage, buying a 16.7% stake in the company. But this wasn't just a financial deal, it was a strategic masterpiece. Monster gave Coca-Cola its non-energy drink lines like Hansen juices, and in return, Coca-Cola handed Monster its global distribution network. Suddenly, Monster went from being a US heavyweight to a global gladiator. Imagine this. Overnight, Monster drinks were rolling out in 190 plus countries, shipped in Coca-Cola trucks, stacked in Coca-Cola fridges, and played next to Coke bottles in places like Mexico to Malaysia. This was the deep Coca-Cola effect, and the financials started showing it. From 2015 onwards, Monster's international sales exploded. It no longer had to negotiate with thousands of local distributors or to invest in cold chain logistics. Coca-Cola's global empire was now its highway. In the last 24 years, Monster delivered a jaw-dropping 34% CAGR. That means if you had invested roughly about $10,000, which is 4.7 lakh rupees in Monster stock in 2003, by 2025 you would have roughly 99.6 crores by now. That's better than Amazon, better than Apple, and even better than Google. No iPhones, no cloud computing, no semiconductors. Just drinks, mass market, low cost, high margin drinks with a tribe behind them and a strategy most tech founders would kill for. Now let's talk about the actual numbers. Revenue growth in 2002, the revenue was roughly just $92 million. But by 2023, revenue crossed $7.1 billion. Now that's a 7,600% increase over 2 decades. When it came to the profits and margins, the gross profit margins often were in the 54 to 59% range. Operating margins were solid above 27%. In 2022, Monster posted $1.19 billion in net income. The free cash flow was over $1.31 billion that year, and the stock price moved from $45 in 2015 to now $95 plus by 2021. Now that's a 170% plus gain, even after adjusting the stock splits, making it one of the best performing consumer stocks of the 21st century. These are margins many SaaS companies dream about, and this is a beverage company. The genius of operational efficiency, they didn't manufacture most of their drinks. They used a model called asset-light co-packaging, basically outsourcing their production and focusing instead on product development, branding, and overall distribution strategy. While competitors burned cash to scale, Monster minted profits from day one. And even when raw material costs spiked, Monster managed to hold prices and was still able to grow their margins thanks to their fan loyalty, share buybacks, and capital returns. As the company matured, it began behaving like a well-oiled compounding machine. It repurchased over $4 billion worth of share between 2016 to 2023, never paid a dividend, just reinvested and bought back the stock, and kept its balance sheet squeaky clean, zero debt, $2 billion plus in cash. Now that is shareholder value creation at its finest. Between 2018 and 2020, Monster stock sort of flatlined, but even during lockdowns, Monster's products kept moving. It had strong shelf presence at the gas stations, convenience stores, and grocery chains, unlike niche brands that relied only on gyms or events. Then came a silent comeback. From mid-2020 onwards, Monster quietly started climbing back, and in 2022, it did something. A 2-for-1 stock split. Every shareholder got twice as many shares and the price was adjusted accordingly. And then again, in March 2023, Monster announced another 2-for-1 stock split. That means for every 1 share in early 2022, you now had 4 by mid-2023. So when we talk about Monster trading at $60 today, it doesn't reflect its full power because pre-split, that's like $120. So when we say Monster went from 90 cents to in early 2000s to over $120. That's roughly a 130x return. The CAGR from 10 cents in 2001 to $120 in 2025 is approximately 34.37%, crushing even the FANG stocks. Now, to conclude this and to put it all together, Monster is more than a drink. It's a rare Wall Street juggernaut built on authenticity, scale, and smart partnerships. Brand is greater than product. Caffeine and sugar aren't unique, but Monster Energy made it cool. Global distribution via Coca-Cola without building it themselves. They expanded to every corner of the globe. Incredible operating leverage, high margins, low capex, and loyalty customers, and insane free cash flow. Zero dilution plus stock buybacks, unlike tech companies diluting shares. Monster ran lean. It was investor friendly. Investors loved the Monster stock. It was a dream cocktail for long term investors. You don't need to build rockets to make fortunes. Sometimes all it takes is a drink that people reach for after a long shift, before a big workout, or just to feel alive. Monster Energy didn't just sell caffeine, it sold identity. It tapped into youth culture and never let go. So while I enjoy my Monster Energy can, please subscribe to this channel for more such cool videos about global stocks, because you won't be disappointed. Cheers.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.